So, okay, so here we are. We're continuing on the session now. We're in the section of my terminology. And so it's pretty exciting that we're going to be learning all these different terms and forms that get utilized within the industry. So you have some working knowledge of this new language that we're talking about in the commercial real estate space. So let's just dive in. We're going to start. I'm just going to walk us through each one of these, and then we're just going to talk about them. So I'm just going to ask you, Lana, what you kind of understood about it. I'll backfill anything because I want to make this as interactive as possible. So the first one was T12. Do you remember what T12 was about?
The T12 is a trailing 12 months, basically like a profit and loss for each of the past 12 months leading up to the most recent 12 months.
That's correct. Absolutely. Yeah. So the T12 is exactly that. It's, if we take, let's say we're because the reason why they say T12 is because we're always trying to look at a fiscal year. All right. So, but every time you're doing a deal, you might not be at the end of December, right in the beginning of January when we've got the full 12 months, right? You might end up being in March or April. And so they're kind of saying like, well, what's the last 12 months of activity that's taking place so that we can determine what is the cash flow for the most recent period, last 12 months. Most of the times this becomes extremely applicable when you're dealing with income producing properties. So like multifamily properties, office, retail, industrial, they're going to really ask for that. That's a really normative thing. They'll say, hey, get me a T12. So they want to know like from this period of time, all the way 12 months, they want to see all the information so they can determine if the cash flow is trending a certain way, either up or down, and to see if there's a pattern there. Okay. And so it's really important to know that they're looking for cash flow. They're looking for trends. And the other thing to notate too is they want to know month by month by month. So when they get a T12, sometimes people will send you the full 12 months in one category, meaning truncated. They want to see each month. Okay. So that's what they're looking for. So they can kind of see conceptually what's going on as well. So that's T12. That's what it's utilized for. And it's something that will be collected on a regular basis. Okay. Any questions about that?
Okay. No, I think I had that one down. Just, using revenue and expenses, getting the income and the total income loss and everything, and understanding that, it's for a lender to see the trends and understand like, okay, well, is this something that I want to get into? What's the risk here? Is this normal for them to be in a good state, or is this like just recent? And yeah.
Great. Good job. Okay. So the next one, right in line with that, is profit and loss. So, I guess pretty straightforward. I think you answered that a little bit, but, profit and loss is, it's everything you're going to be dealing with, right? All the way from the small business owner to the, income producing lender. You're going to be getting profit and loss statements for everything. Now, let me just kind of break that out a little bit. So a lot of times they're going to ask for, if it's business, okay, if we're dealing with business owners, they're really going to be asking, they want tax returns. Okay, that's really what they're looking for. Or they want audited financial statements. Those are just as good. Okay, so they want tax returns for the business. And that really gives them the cash flow they want to from a taxable perspective. If they haven't filed the tax returns for that period, so like a lot of people have not filed the 2021 yet, but they're on extension. So they'll want to see a profit and loss for that period of time. Plus they're going to say, I want the interim period. And what that means is they want the interim between whatever the end of that fiscal year is to whatever period is today. So if we're in June, interim would basically say, I want January all the way to, I'd say May, because June's not fully closed out. Today's the 30th. They're probably not going to have June, probably halfway between July. So they're just going to want the closest period of time up to whatever that date is. Okay, so whenever you hear interim, I need the interim financials. That's what we mean by that, okay? So now typically speaking, if we're dealing with income producing properties, we're not really asking for tax returns. Sometimes they do if it's a bank, but generally speaking, it's just standard profit and loss statements that again, could be on a spreadsheet, could be just in a PDF format that they got from QuickBooks. But either which way, that's what they want is the detail on that. Now, once in a blue moon, every so often, somebody has really bad records and they want to kind of chicken scratch something out on a piece of paper. And we're going to have to push them a little bit to go further than that. So, I have seen napkins before, and as much as they don't do anything for us.
This, it's kind of, this is the general idea.
Yeah, it's nice, but that's not going to work, right? So they've got to have a profit and loss statement. So again, profit and loss, pretty straightforward, period of time, and tells us their cash flow. And then we're going to talk about balance sheet now. So you kind of maybe give me your understanding of a balance sheet. What do we mean by that?
Really quick on profit and loss. Is that what you're referring to? You say P&L, or is P&L something different?
Yes. Yeah, great question. So yeah, P&L is profit and loss, 100%. Yeah.
Okay.
Yeah, a couple of terminologies you'll hear too, like profit and loss, P&L, income statements, operating statements. Those are all synonymous.
Okay. Thank you for the clarification. The balance sheet is basically just showing the assets, liabilities, and equity of an entity.
100%. Yeah, 100%. And something to be cognizant of when you get asked, when you're asking for balance sheets, you want to make sure a couple things. Number one, you mirror the date of the most recent profit and loss and the balance sheet. So if I ask for June, okay, so if I ask for January through June of the profit and loss, then I want a June balance sheet. Okay, they want those to kind of line up. Okay, so that's the first thing just to notate. The other thing to be cognizant of is when you request these things, and this really technically is most applicable for the small business owner, is you're going to ask for balance sheets and profit and losses for every and all entities, okay, that they have 20% or more ownership in, okay? So let's say, for example, Dave Cotter owns Integrity Capital Markets, KH Holdings, they're, all like 4 or 5 different companies, okay? And I have 20% ownership in them or more, they're going to want all the information on all of those entities just as much as they do the primary entity, which means whatever the operating company that's going to function in that building, okay? They want to see all the information. And the reason why is because they want to look at this global picture of cash flow. And let me give you an example. Let's say that my XYZ company is really doing well. And you go, great, you're making a ton of money. Cash flow is great. We're happy as a lamb. But my other 4 entities are like struggling, right? They're just, one's maybe losing a bunch of money. This one's losing, maybe this one's just barely scraping along. Well, all this cash flow from here could be getting drained potentially by all of these other entities, okay? So what they're trying to do is they're trying to say, well, this is great that you cash flow here, but we want to make sure that you're healthy in totality, okay? Does that make sense?
Yeah, so it's just like basically to make sure that even though the one that they, like the entity that they're looking at lending on, even though that could be good, the other one's being bad can mean like the other one's going to end up suffering because of this, right?
100%. But you've kind of heard the statement like robbing Peter to pay Paul, right? Like, so
yeah,
like a lot of times people will be like, hey, this is doing great over here, but it's like, well, yeah, but you're draining all the cash flow out of here to pay for all the things that are dying on the vine, right? And so, so that's cause for concern. Doesn't mean it's a deal killer, but it's something that we need to be cognizant of, because remember, the number one thing they're always looking for is risk, right? Risk, 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 risk. So they're saying, well, that's an additional risk for us to be able to see that. So those are sort of those things that you have to be cognizant of, is to say, what other entities do you own? And we need to get the information for that. So it's good to notate. So I'll pause there. Does that make sense?
Yeah, no, I'm definitely tracking.
Okay, good. And I guess the final thing on the balance sheet is, when you get the balance sheet, you really quickly want to go to a couple of areas. One is you want to quickly go to cash on the balance sheet, because they usually have the current assets, right? Current liabilities. You learn that one in some of your finance classes. They'll have you do this quick ratio, right? Where you're kind of doing current assets over current liabilities. But what you're basically doing is you go cash real fast, because that's what they're going to look for. Say, do you have any cash? You know, and if they have very limited cash, that could be a red flag. You know, they could say, well, where's all the cash coming from? So we have to be the ones that go like, hey, where's the cash? You're supposedly buying this building for $2 million. You're going to have to put down $400,000. I'm only seeing $100,000 on your, right? Like, so where is it, right? Where's Waldo? So it's just something that we need to look at. And they might go, well, it's on my personal finance. Okay, so, great. But we just have to be sort of looking for those kinds of things like cash. Okay. The other thing is going to be liability. So if you look on there and you go, man, you got a lot of debt, right? That's not necessarily bad, okay, in of itself. Debt isn't necessarily bad, but you could have good debt and bad debt, right? So someone could just be way over leveraged and just have tons of payments, and they just don't have the ability to make the payments, right? So as soon as you go to the balance sheet, it's really something that's going to tie directly to one of the other things that I believe is on our terminology, which is business debt schedule. Because even though you see the debts, the business debt schedule is going to be an extraction of each one of those that tells you, well, here's what it is, here's how much I borrowed, here's how much I owe now, and then here's what I'm paying every month. Okay. So that gives us a picture so that we can say, well, you're making all these payments every month, Mr. Borrower, and you're paying out like $50,000 a month in debt payments, but your cash flow is only like 30, right? So if that's the case, you're getting the money from somewhere, right? Because it's not from cash flow. Right. So those are the kinds of things we have to do. So that's what I'm saying when I say that. So does that make sense?
Yes, but I don't think that business debt schedule is on the terminology, at least the first one that we went through. So if you could give me a quick rundown of that, I guess.
Yeah, 100%. Good question. And I'm just doing a quick scroll and to see if it's not on there. And if it's not, for crying out loud, it should be. So we're going to add that for next time. So great catch as always. So so business debt schedule is this. It's a form that we provide to the borrower. In fact, what I'm going to do is I'm going to pull up this so we can. All right, here we go. Okay, so I'm going to pull this up. Okay, so right here, you see that?
Yeah.
Okay, so this is our business debt schedule form. Okay, and on this form, you'll see that we'll have the creditor name. So who is the person that lent you the money? You will have the original amount that you want them to put on there. So they have to fill this out. Hey, where's the original amount? Here was the original date on there. So when did you borrow the money? What's the current balance outstanding? And what is the interest rate on that? And what's the maturity date? When does it actually mature or balloon? Do you know what I mean when I say that?
Yeah.
Okay.
Like when it's done, basically, like when it'll be over.
Yeah, correct. When it's all done, and then the monthly payment.
Mhm.
And then they want to know the security, meaning, okay, so you borrowed $150,000, but did they take a lien on your house? Is it against equipment? What's the security instrument that they tied that loan to, if any? Or it could just be a line of credit.
Mhm.
And then the final thing is they want to know, is it current or delinquent? Okay. And I added a few things, which is what is the entity that it's tied to? So again, if we have multiple entities, I want to know business debt schedule for every and all entities. Does that make sense?
Okay. Yeah.
Okay. So a couple of things to just be cognizant of here. When you're doing this, you could have someone that borrowed $1 million. They could have, 150,000 left to pay. Okay. And their monthly payment could be, $25,000. Okay. And you could be running the cash flow and you can say, well, it doesn't work because your debt payments are too high. Well, if I notice they have 150,000 left, they're paying 25,000, that thing's going to be paid off like in the next couple of months ish, right? So I'm not overly concerned about it because it's like, well, that's going away. So that 25,000 a month is going to be gone like quick. So that's just something, as you're kind of looking through it, you're like, okay, that's something I always watch for, because then you could always tell the underwriter, it's like, well, it's not really going to be there for a long time. So
yeah.
just something to be aware of. The other thing is the interest rate. There have been times where a deal did not work, meaning that the deal was going to blow up. It didn't cash flow. The lender's like, we can't do a loan. And I came back and I looked at their debt schedule and I'm like, well, hey, what if we just refinanced all their debt? We basically cut their payment in half and now it works, right? And they're like, oh, yeah, I didn't think about that, right? So, because I go, well, gosh, their interest rates they're paying are like super high. And so we could just refinance those, get them into a lower rate that's half of it, and save them money and get the deal done, right? So this is why looking at the business debt schedule is really important. And it should, again, tie to the balance sheet, okay? Because,
so it should be as of the same date that the balance sheet is.
well, yeah, preferably, yeah. Okay. So that is the business debt schedule. And I'm actually making a note for myself that we're going to add that in there. And it might be in a later thing too, I'll check, but good catch. Okay, so let's continue on to projections. Okay, we're all kind of in this P&L project. So what's your understanding of projections?
Like basically saying like, this is what we're expecting this to profit. Like this is the, I mean, I'm trying to say it without saying like projection, but like this is like our projection for what the cash flow is going to be for this entity. And it's like a profit and loss statement, but in the future.
Yes, exactly. So projections are applicable in a couple of different instances. Number one is if you have a small business owner who's literally just starting up, okay? They have no history. They need to put a business plan and projections together. And so they're going to have to literally walk through the exercise to give the lender probably 12 to 24 months of information, okay? And usually they want at least the first 12 months to be month by month. They want them to go through a month by month projection to see how much they're going to make or not, okay? Or how long they're going to lose money for. Because the lender has to look at it and go, okay, when are you going to become profitable? The other thing they're going to say is, how did you come up with those conclusions? Okay. Because everybody can come up with projections, right?
Yeah.
But the question really is, at the end of the day, is what were the assumptions that you made for that deal? So when I do projections, I've been doing it for so long, I can make pretty good assumptions about like, well, I think we're going to probably close about 15 deals per person. That seems normative. And we think the average loan is about, call it 2 million. So that means this is the fee. So they want to see like, how did you come up with your revenue? How did you come up with your expenses? And the reason why most people fail in business is because it's not because they're not smart. It's because they didn't force themselves to go through the exercise of doing a business plan, doing projections. And it's not like the business plan is the thing that makes them successful. It's all of the things they had to do to think through like, okay, so how's that going to work?
Yeah.
Right. So the projections kind of help a lender go, okay, looks like it's going to take you about 9 months to get to profitability. That means you're going to have about $150,000 of loss between now and then. So how are you going to come up with that? Right. We need to get a line of credit, things like that. So that's one of the things you'll see the projections are utilized for. Okay. The other thing will be if it's a new construction for a income producing property. So let's say it's a hotel or an apartment or whatever, office, retail, industrial. They want to do the same thing. They want to say, okay, how long is it going to take you to build the construction? Okay, well, let's walk through that. It takes 12 months. Okay, great. So as soon as you open up and you get certificate of occupancy and start being able to rent to people, how long is it going to take you to get fully occupied? Okay. Is it 6 months? Can you pre-lease for 5 months? Like what's that going to look like to where you're going to turn that corner of profitability? Because remember, lenders always focus on risk, which means they want to see when are you going to start cash flowing so that we know we're going to be able to get paid back, at the end of the day. And then they're going to look at it and say, well, they're going to do their own homework, right? If you're lending me money and I just said, well, here's all my assumptions, Lana. And you're like, well, that's great, Mr. Cotter, but I'm going to do some of my own research, okay? And I'm going to go look and see if those rents you gave me are really market, right? Or did you like fluff those up? And, are those expenses kind of realistic? And then I'll make the determination if that's accurate or not, right? And so all that sort of germinates around this idea of projections around things. The third thing you might see is if a business is expanding, okay? So all of a sudden, like when I had to do this with our bank, I'm like, hey, we're opening in different states. He's like, okay, well, you got to, and I already knew that. So I was like, well, here's my projections, okay? And here's how I came up with this, and this is what it looks like. So, it's not like I don't already have business, but it's like, well, you're expanding now. And so what does that look like? And how is it going to impact your existing business, at all? So those are kind of the sections for projections. So I'll pause for a minute, see if you have any questions or if that makes sense.
The projections resonated pretty well. I had to do a business valuation, which was really, really long. It was like 86 pages. And so I had to do, and that's not including all of the Excel work that we had to do all the projections for the next like 6 years of the company or something. So I am familiar with that one.
Great. Well, it sounds like you got knee deep into it. So that's
oh yeah.
very tedious. So good job. Okay, rent roll. Do you remember what a rent roll was?
The rent roll, I think, is what shows like all of the current tenants, or well, I actually had a question about that, but basically like all the tenants and all of the relevant information about them, like, you know, what units they're living in, how much they're paying for rent, when their lease is up, um, anything of relevance to the loan.
100%. Did you have a question you wanted to ask, or do you want me to dive in?
It was just really small. So does it, I noticed on the example that was shown in the video, it said like status current. And so I was going to ask if there is ever a time that they would have like previous tenants listed on the rent roll.
Like previous tenants that were like used to be in there but aren't now?
Yeah, I just saw that it said like status current. So I didn't know if that was like
Yeah,
talking about they're like living there or.
yeah, great question. So the status would be something like this. So let's say I've got industrial building and I have 5 tenants. And you know, Johnny's HVAC company has, you know, their tenant name, the square footage, monthly rent, blah, blah, blah. And it shows that they're past due. So when I say current, what we mean by that is they're making their payments on time. And Johnny might be behind 3 months. Okay. Well, if that's the case, I kind of want to know that as the lender, because then I go like, hey, what's going on with Johnny? Well, you know, he got a little behind in COVID, and, you know, he's making it up. And, you know, and in fact, I'm doing a yoga studio deal right now, and the yoga studio has $18,000 in back rent. Okay. And we had to find out what was the story, what happened. Well, evidently they opened up a second store. They kind of got in over their skis. They just expanded too fast, and just didn't do as well as they thought they were going to do, right? Probably didn't do projections. And just,
Yeah.
it just did it. And then all of a sudden had to kind of go back to the landlord and go, oh crap, you know, think I took too much on. And the landlord was like, well, okay, he was a bit of a softie. So he's like, all right, you don't have to pay rent. And, you know, so months and months and months, this thing accrues. And finally the landlord was like, hey, you got to pay me rent, right? So we kind of had to get the story of what went on, but ultimately we're doing the deal. Just, you know, he's past due $18,000. And so that's what we mean by, you know, status, essentially.
Okay.
Okay.
Thank you for the clarification.
Yeah, great question. Okay, so you know, again, unit number, it's just good to know, you know, what unit are they in, because sometimes you're going to tie that to their leases. They're, you know, okay, this is who it is, right? And it helps you know how many units there are. Tenant name is, again, sometimes this gets a little tricky because they might give you their business name, like DBA, doing business as, but the way the lease reads is it's a different name. So, you know, I might be, you know, XYZ LLC, and that's the actual name of the company, but I might be doing business as, you know, John's Flowers or whatever, right? So you just have to kind of know when you look at the lease. So, well, wait, it says John's Flowers. Who's XYZ? Oh, that's them. Okay, cool. So that's the only thing to be aware of that's pretty common. Square footage, pretty straightforward. How much are they taking of the total amount? If the building's 10,000 square feet, he's taking 2,500 square feet of the 10, which that will be important, especially if it's a triple net lease, which we'll definitely get into as well. So monthly rent, how much they paying, annual rent, and then what is the start and the stop date, right? When does it start? And what they're really wanting to know, it's really important, is not just what is their new lease start date, but when was their original start date, okay? So when did they start, like all the way back from the beginning to what is their lease period left, okay? The reason why that's important is because sometimes I've seen month-to-month leases, but I pushed in a little bit and said, well, how long have they been there? Because lenders don't like month-to-month leases. They think it's risky, right? They're like, well, they could leave at any time. And what I try to make the argument is, well, yes, you're right, but John's Flowers have been there since like 1995. So he ain't going anywhere, you know. He's
And month to month is usually like it's more expensive usually, isn't it? So you'd be making more profit than you would be if they were every 6 months or every year.
100%. Yeah, and so it could be just that like they're just like, I just don't like signing long-term leases. That could be one scenario, right? It could just be that they legitimately are saying, hey, look, we're going to probably move. So, you know, I just don't want to sign a lease. Or, you know, or there's just some reason they're just non-committal. I mean, who knows, right? But we definitely, it's worth understanding because it helps you make the argument to the lender that, you know, that you need to do something. Okay. So the CAM amounts, which means common area maintenance, okay, typically speaking, this is mostly applicable for retail centers. So retail centers are going to have what's called triple nets or CAMs, common area maintenance. What that means is that if there's, I won't go into too much detail because you'll learn about it if you already haven't, but there's several kinds of leases, okay? A triple net.
Yeah, triple net is when I can't remember if it's I think it's the landlord pays for everything.
Yep, good job.
They take care of everything. Yeah.
Yeah, absolutely, 100%. Good job. So no, sorry, triple net is when the landlord does not pay for everything. Okay.
Okay. The tenant
So
takes care
the
of all the
tenant
property
takes care of everything.
expenses,
Yep, 100%.
taxes, all of those things. Okay.
Yeah, 100%. Taxes, insurance, maintenance, management fees, you know, all of it. Like any and everything that has to do with it on a true, they call it a true triple net, is when the lease is going to be passed through to the tenant. So that's why they call it net, 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 or NNN. You'll see that. Or triple net, right? Those are kind of the synonymous things for saying the tenant is paying everything. Okay, so Walgreens does that, CVS, Target, right? So, you know, and so what they do is they say, okay, well, Lana, if your business is in there and you're taking 25% of the whole space, whatever the total expenses are for the year, you're going to absorb 25% of that amount. Okay. So if it costs $100,000 a year to operate this thing, you're responsible for 25,000 of that. Okay. And then the tenants in the other one, if there's another tenant who takes 50% of the space, they're responsible for 50%. So that's why the square footage is important, because then you're seeing it as a percentage, okay, of that total amount. And then what'll happen is they'll either be making that payment on a monthly basis, okay, or they'll be making that on an annual basis or quarterly, depends. You know, each person does it a little bit differently. But it is something that is done on a incremental thing. And then at the end of the year, what they do is they'll reconcile everything, where they'll say, okay, well, what did it really cost us? If we charged you X amount a month, what did it really cost us, you know, to do it? And then they reconcile, which means if you overpaid, then if I'm the landlord, I say, well, Lon, I got to cut you a check at the end of the year because you overpaid me. Okay. So we're sort of like, you know, we're good. Or I say, hey, you underpaid me, so I need you to cut me a check for the difference. Does that make sense?
Yeah.
So pretty normative, that they'll just sort of put a CAM amount monthly, and then they kind of reconcile at the end of the year. Does that make sense? Are you tracking with me so far?
So common area maintenance and triple net lease are the same thing? Or
Yeah,
is
good
common area
question.
maintenance
Well,
like
yes and no. Yes, in the sense that triple nets are, hey, you're paying everything, right? Common area maintenance basically. So triple net says you're paying everything. Okay. CAM is just saying Well, what are the common area maintenance items that are in that list? So I could still have CAM, and those are expenses for common area maintenance, like, keeping the roof clean and, making sure the parking lot is paved and, having the janitor come in and et cetera, et cetera. But, but it could be a gross lease, which means, well, Mr. David is responsible for that, not Lana. Okay. So common just says, here's the expenses. Net, the type of lease will tell you who's paying for it. Does that make
Okay.
sense?
Yeah.
Okay, good question. So, and then obviously past dues, pretty straightforward. They're either paying on time or they're not. And what'll happen is there's a document called the estoppel. Have you ever heard of the estoppel before?
No, I haven't.
So an estoppel basically, so let's say, in fact, it's kind of funny because right now the building we're leasing, they're selling it, okay? And I signed a lease and paid the rent for the whole year. And so the guy said, hey, sorry, we're selling the building. I'm like, well, you owe me money, right?
Yeah.
And he said, because of the new ownership, they will have every tenant sign an estoppel, okay? And here's basically what it is. Essentially, what they're wanting to know is, hey, we got all these leases from the guy that's selling it to me, but I want to confirm legally from you that this is accurate and correct. I don't want a bunch of fraudulent leases and I just close on it and find out it's like, well, I'm not paying that much in rent, right? And so it kind of confirms the lease that they receive in there, if that makes sense. The other thing that it does, Lana, is that it also, it basically also confirms if there's any issues. So let's say that I'm a tenant and I've been whining at the landlord for the last like 3 months, like saying, hey, dude, there's a leak in my roof. I've told you about it like 6 times and you're not doing anything, right? And so the lease would confirm to the new owner, like, hey, I stopped paying rent or I stopped paying my CAMs for the last 3 months because, landlord's not doing anything. I'm paying for this, but I'm not getting anything for it, right? So it just confirms problems, essentially. So it's kind of a checks and balances document. So does that make sense?
Yes.
Good. Okay. So that's kind of rent roll. So that's a lot, right, to take in. I mean, we've just covered a lot of stuff. But it is important because you will, if you do a lot of income producing properties, this is just kind of like, bread and butter.
Run of the mill.
Run of the mill. You're going to run into all the time. Profit and loss, rent rolls. You'll have nightmares about it in your sleep. Okay. Articles of organization. Do you remember what that is?
It's the basically the way that an LLC becomes official through its local jurisdiction. And it has like who the members of the LLC are. And it gives them like, what kind of stock would be issued for them and just like the different basics for them. And it allows them to like be active, like I can't think of the right word, but
I know exactly what you're saying. No, you're hitting the nail on the head. So yeah, so it's a document which basically solidifies that you are a legitimate business in the jurisdiction, right? So state of Arizona, state of Texas, et cetera, et cetera. So basically I have to go in and say, I'm going to form this LLC, limited liability company. And again, we could say synonymously articles of incorporation or articles of organizations for LLC. Articles of incorporation is for a corporation. Same thing, just 2 different types of entities. But basically, I'm going to the state and saying, hey, I'm going to pay you a fee, $85, typically somewhere in that ballpark. And I want you to give me a formal document that I have the right to do business in your state and it's official. Okay. And so even though I'm kind of a foreign entity or whatever. I'm still doing business in the state. And so that's what the articles of organization does. And lenders will ask for it because they basically they want to know it's official. They want to know that it's that the LLC is in good standing, which is another thing that we'll talk about, the certificate of good standing. So you, first of all, articles just say, hey, you're official, okay? Certificate of good standing says you're in good standing, right? Or not. Because they might say, hey, you haven't filed your annual report for the last 2 years. So we're not going to give you a certificate of good standing until you do that, okay? And you say, well, who cares, Dave? Well, the lender cares because he or she is saying, well, if I lend against your LLC and it's not, in good standing, then that's a problem because
Yeah.
an illegitimate company, basically, right? So it's a big deal. And it's kind of one of those annoying little nuanced things that you have to get, and you have to call the state sometimes, and every jurisdiction is a little bit different. So that makes sense.
Yes.
Okay, yeah, nothing too much about those. Okay, this is one you're going to definitely be dealing with like a lot, is personal guarantee. Do you remember what that's all about? Non-recourse or personal guarantee?
Personal guarantee, or otherwise known as like recourse,
Yep.
is whenever they sign off and say like, yeah, you can, basically the borrower saying like, you can come after me if I default on this loan, and then non-recourse is them agreeing to not go after them if they like default on the loan, unless they violate a carve out like fraud or negligence. Yeah.
Picking up on it fast. So yes, so recourse is basically saying that exactly what you said. It's basic. What I always tell people, I'm like, look, you're basically put a noose around your neck, because it's like when you sign that thing, they're saying if you slip, I got you. And I've experienced that before when the recession came, and why I have all these gray hairs, right? So I had to pay all the debt back, but that was not a fun time. But basically, so when you sign, you're basically saying, look, if this doesn't work out, like, you can come after me personally, after all my assets and all the things I have. You can garnish my wages and drain my bank accounts and all those fun, wonderful things that nobody wants to experience.
Yeah.
But so that's so people don't. It's important to understand, because it's important for us to communicate it to the borrower, especially a small business owner, because they are very ignorant, understandably so. They don't do this every day, right? Like, they just don't understand. They're used to doing like a home loan, and it's just like, there really is no quote unquote recourse, because there's the Homestead Act and you could sell it, you'd be fine. But in business, it's like, hey, if this doesn't work out, like, they could literally come and take possession of your assets. And it's, so people need to kind of understand that conceptually. So I take the time to explain it to them. And they're like, what? Like, I know, it's just, it's how it is. So you sign the dotted line, you're in it to win it. So that's kind of what it is. Obviously, the lender has to go through a process to do that. They can't just, go after you. They have to go through and foreclose, then they have to take the asset back, then they have to go liquidate it at the court steps. Then they have to, if they don't get all the money back, then the deficiency,
Then it's you.
right? So it's a lot. It's a lot. But the non-recourse side, again, is it's pretty rare with a bank that you're going to do non-recourse. It's pretty rare. Like, there's, most of the times, there are instances they can, but almost every time they want a personal guarantee. Okay. Non-recourse is very applicable for life companies, CMBS lenders, private lenders do it all the time, because they're really focused on the asset itself, and the income that's generated from that. So they're willing to do non-recourse. Now they underwrite the living daylights out of it. I mean, there's tons of stuff that they get. And so you're just like, whoa, that's a lot of paperwork. But they're like, hey, we're focused on the assets, so we want to know what it works. And so non-recourse is very much there. But again, I always tell people, I'm like, look, it's fraud. They'll come after you, or you're negligent and start deciding it's a good idea to dump chemicals on the site. Well, then watch out. So it's not 100% bulletproof. It's kind of like people
Kind of ask for it at that point.
yeah, like, oops. Okay, so personal. So does that make sense? Any questions around that or anything? Okay, good.
Or yes, it makes sense, but no questions.
Yeah, no, good, awesome. Okay, so personal financial statement. We'll kind of talk about this one and then we'll land the plane. So personal financial statement. Do you remember what this one's about? By the way, this is a big one. You're going to deal with this all the time.
Yeah, it was. I have all my questions written down as I took all my notes, but in like short terms, the personal financial statement is kind of like a balance sheet of the person, if you look at it that way, but it's all their personal assets. Nothing from the business can be double counted or like claimed as their own, and just really looking at like if they have the cash to back up the loan, like whenever it comes down to it.
100%. Yeah, exactly. It's just like a balance sheet for a person, right? You and I, we got cash. Hopefully we do some days. We have some assets, maybe we got a house, or maybe we have a car, maybe we have, paintings, whatever, right? And then, if it gets even more detailed, they want to know the business value. So what'll happen on there is like in the business or in the personal section, they'll say, what's the business value? A lot of times people put the total value, not the net. So, and then what'll be happening is they're double counting it because they already did that on a balance sheet. So we want to know what's the net figure, the equity in that company that goes over on the asset side of the personal, because it flows through to the personal. Okay. So you have to be cognizant of that. And it's really important. This happens all the time. And again, understandably so, people just don't know, but they'll put business assets on the personal financial statement. So let's say, for example, I own an apartment complex in an LLC. Well, that LLC should have its own balance sheet, its own profit and loss statement, right? Separate. But if I take that asset and I put it on my personal financial statement as an asset and the liability on there, then I'm doing that wrong. The only thing I should put on there is what is the net value of it, and that goes on there. Does that make sense what I mean by that?
So like when you say the net value, do you mean like I guess what pertains to that person,
Yeah.
like the percentage of it that, okay.
Yeah, so like let's use an example. So let's say that I own an apartment. It's worth let's say it's appraised for $1 million. Okay, and I owe 500,000. If you take that million minus the 500, that net equity, like maybe that's another way to put it, is $500,000, right? Mm-hmm. So that 500,000 net equity would go on my personal financial statement as a asset. Okay. What I wouldn't do, and it happens all the time, is most people take that $1 million and put it on there on the asset side, and then they'll put the liability of $500,000 on over here on that side, and then you're basically kind of double counting. Does that make sense? And so because you're like, well, wait a minute, you have $1 million here and $1 million here, that's 2 million. It's like, well, no, it's
yeah.
one. Okay. So again, common mistake, pretty normal. It's just an education, essentially. And you're trying to, again, look for the details of cash. Okay. And you're also trying to see their debts, and understanding like how many debts do you have. They'll pull a credit report, and in the credit report, they will uh, essentially see if what you put on there kind of matches up, right? So a lot of times people put some on there and then they go, oh crap, I forgot that, right? The 10 credit cards I have. And so it gets caught on the sort of, credit bureau. So that's personal financial statements. Do you have questions?
I have quite a few. So my
Sure.
first thing, well, just related to what you were just saying. So as like someone helping them fill out or helping them like get their statements together and everything, what I guess if they're forgetting something, is there a way to be like, it's for us to know before it gets to the point that like a lender sees them without what they're supposed to have on there, and then it's like to explain, or is it just kind of like we have to hope that they have their stuff right?
Yeah, it's a great question. Yeah, what part of our job is to basically educate and walk them through it. And so we explain it to them. We kind of walk them through and go, okay. So I always get it back. I explain it to them first, and a lot of times I'll send them a video. Okay, we created some videos and it explains like how to fill it out. Sometimes they don't listen, but that's okay. So we want to try to educate them. And so they'll send it back. It's half filled out or, whatever. So it's always just kind of like, hey, we got to get all this stuff filled out and then signed. And so we usually are vetting that out quite a bit up front because the lender will ultimately. And what I always say to them, and I usually have to say it a few times just to remind them, I'm like, look, whatever you have, just put it on there, right? Because some people just, I don't know why it is, they just have this thing in their mind of like, I have to hide this or don't tell them that.
Yeah.
Or like, it's just kind of, there's this weird, almost like adversarial thing between them and the bank. And I'm always like, look, just be upfront. They're going to find out anyways. And if they do, and they're halfway in the process, you just lost trust, right? Because they're like, why do you do that, right? So I said, just lay it all out on the table, right? But then we know what we can deal with. So yeah, so we have to educate them for sure through that.
I know it's 6:02, so if you need to go, then that's okay. I have like kind of a lot of questions, so it's okay if
All right,
we have to wrap up.
let's spend a couple minutes. I'm fine. Let's try to knock them out. I'd like to get them answered for you before we finish, and we can really close that up.
Okay. In what cases, like, is it only whenever a married couple keeps their finances completely separate that they would have like two different personal financial statements? Or are there any times that someone's like, well, we just want to have our own or something? Is that ever like an issue? And then in the video, it was talking about like that creating issues for the underwriters. Like, what does that mean? Like, what does it impact the underwriter, I guess? Like, how does that make it harder?
Yeah, great question. So there are instances, yeah. So like if somebody, let's say two people got married later in life, one person, or maybe both of them came from a lot of wealth. Okay, so like they inherited a bunch of assets and they basically signed a prenuptial agreement in advance, right? Like, hey, you're agreeing before we get married that you're not going to go after my assets if we get divorced, kind of thing. So they have this prenuptial agreement. And so in those instances, we would have totally autonomous financial statements, right? Because technically, even though they're married and common law really is usually the overriding jurisdictional law, this supersedes it, meaning that it overrides it. And so their prenuptial agreement basically says, well, we understand it's common law, but we have an agreement where we both agree together that we're not going to go after each other's assets, right? So they would have separate financial statements. Okay. The only other time that you would generally see that, and this is actually a question we ask, you're going to learn this in our application process. And we asked it for this very reason. It's unfortunate, but it happens enough. But I always say to the borrower at some point, we have to ask a lot of kind of uneasy questions sometimes. So kind of have to get used to like, we have to know everything. So I always am like, hey, I know it's a little bit of a trickier question, but is everything going okay in the marriage? You guys going through any divorce? Is there anything going on? Right. And, there's been plenty of times where like, yeah, actually we're in the middle of divorce, right? We're like halfway in the middle of it right now. And so that gets tricky because, and then it gets, I have to dive into more things. Then I'm like, okay, well, again, it's going to get personal, but like, is this adversarial? Are you guys cooperative? Like what's going on? And, sometimes it's like, no, we hate each other. Sometimes it's, we're both fine. We're happy. Da, da, da. And even then I'm like, well, I need her or him to sign a document, basically says when we get to closing that everybody's still going to sign, right? Because, we're going to waste a bunch of time if we get down there and one spouse goes, hey, I'm not signing that. You're crazy. And so in that instance, there could be like, hey, we need to sort of understand what are the final assets going to be, like who's taking what. So that could be another instance for sure. Yeah. So fun conversation.
Yeah, and it'd be super fun. Hey, so are you like happy with each other?
It's like, it's just the most weird. I've been on the phone late at night, just like, oh man, did I just turn into a counselor? So, okay.
Like, are you sure you're not happy with each other? Because it'd be really good for the loan if you were.
Let's just all get along and then you guys can hate each other.
Just wait a few months, can you?
Hate each other after that. Wait.
Like you've been together this long, it's fine.
Yeah.
Global cash flow, that term was used a lot. What does that term mean?
Yeah, great question. So global cash flow basically goes back to this concept of this. I want to look at the business entity itself, okay, that LLC that's going to be the operating company. So I want to know the cash flow of that. So it's like, check, okay, great. Then I want to go to their personal level and I want to say, well, what's your personal cash flow like? Okay, personal assets, personal liabilities, what's coming in, what's going out. And then I'm going to take all of those things together and say, well, combined personal business cash flow, how do you do in servicing the debt in totality, right? Kind of goes back to that thing where I said, well, you could be doing good over here, but you're draining all this cash here, okay? And so the lender wants to know, well, globally, are you doing okay? All right. So those are the kinds of things that I mean when I say global cash flow, personal, business, combined. Okay. That makes sense?
Yeah. I think I might know, but I just wanted to make sure and clarify. When it says that there could be multiple applicable entities, is that like whenever they kind of like open multiple LLCs to have like each separate building or each separate like property?
100%. Yep. Multiple entities, separate entities are exactly that. Yeah, you could have several entities to own a. Most people will set up an LLC separately for each asset. It's most attorneys, if they're worth their weight in gold, they're going to say, hey, you shouldn't have everything in the same entity, because if you get sued on one property, then they're going to go after all of them. So.
Okay. On other assets on the personal financial statement, it says that it should include the net worth of the business and the real estate that they own. Yep. Is it only after it's completely paid off, or is it like even if they're like still making payments towards it, or?
Yep, 100%. Yeah, both. So good. They can still have debt, and because you're just going to take, again, in that instance where we're like, and it could be business too, by the way. It could be, like if somebody owns a business and they say, well, what's the business worth? Well, it's worth 10 million bucks. Okay. Well, how do you owe anything? Yeah, I owe 2 million bucks. Well, then they're going to put 8 million, because 10 minus the 2 goes in the net category. Okay. So if they don't owe any debt on the real estate or the business, then they're just going to put that value over there. So it's the net value, essentially.
Gotcha. And then under the liabilities, I don't know if it was like a discrepancy, but what personal loans go to accounts payable versus notes payable? Oh wait, what personal loans go to accounts payable versus which ones go to notes payable to banks and others? It said that personal loans go under both, and so I wasn't sure what the.
Yeah, it's a little bit nuanced. So like accounts payable in its traditional sense is like if I owe a company, so let's say that you are a plumbing parts company, okay? And I come in and I say, hey, I need to buy some plumbing parts from you. And I say, can I do it on terms? So like, so I want to buy the plumbing parts from you, and I don't want to pay you cash today, but there's an IOU, right? So I owe you in the next 30 days, I owe you the $600 for this, right? Well, technically, that's going to be an accounts payable on my personal, the balance sheet, so to speak, right? And it's going to be an accounts receivable on yours because you should be receiving that, if that makes sense. Okay. And so that's what we mean by that. Notes payable is kind of like, it could be an automotive loan, could be a line of credit, things like that. That's what a notes payable, so those are sort of the distinctions between the two.
Okay, thank you. And then let me make sure that my previous questions didn't go with anything else.
Sure.
Role. We haven't we haven't done LTV and LTC. So yeah, those are all my questions for the personal financial statement.
Great questions. You are very smart, curious, good question asker, and
Thank you.
so great job. Okay, so we're good to go, and